Hey everyone, in this video I'm going to cover one thing that smart investors know about Carnival Corporation stock. It's the one thing that smart investors are paying attention to with Carnival stock that presents a huge opportunity, and it might not be what you think. I know you're thinking Carnival Corporation is benefiting significantly from pent-up demand from consumers looking to travel and spend money away from home. But that's not the one thing I'm talking about in this video. So let's jump into the details. Let's see what that one thing is and why it's critical for Carnival stock investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so while what I said earlier was completely true, Carnival is benefiting from huge unleashing of pent-up demand from consumers looking to get away from home, spend money away from home after being cooped up during the pandemic. That's not the big thing here. That's not the big thing here. The big thing with Carnival Corporation right now that savvy investors are paying attention to is this opportunity to reduce the long-term debt. Now, you can see the long-term debt surged during the pandemic when Carnival had to shut down operations completely for several months and longer in some locations. Total debt increased from 10 billion all the way up more than 33 billion. It more than tripled. And of course, when you borrow money, you've got to pay interest on that debt, right? Moreover, when Carnival borrowed money while its operations were shut down, it had to pay higher interest expense because it's a greater risk, right? Put yourself in the perspective of lenders during the pandemic when Carnival had to shut down operations and it was losing billions of dollars every year. Would you lend to Carnival? Maybe you would, but if you would ask for a really high interest rate to compensate you for the risks of Carnival because it's shut down, its operations were completely shut, it's losing billions of dollars. You didn't know as a lender when or if they were going to be able to reopen, if they were going to make it to the other side. They were significantly at risk of going out of business because if they were to remain shut down for very much longer, they could have gone out of business completely. So as a lender, Carnival was a huge risk, and so you charged them a higher interest rate because they were a greater risk. And so not only did Carnival add more than $20 billion in debt on the balance sheet, that was high interest debt. That was higher than usual interest debt. That's now becoming an opportunity because now Carnival business is booming. Let's take a look. So in its latest completed year in 2023, cash from operations totaled $4.3 billion. Adjusted free cash flow was $2.1 billion. And so that freed up a lot of cash that Carnival opportunistically used to pay down debt. The company paid $6 billion in debt in 2023, reducing its debt balance by $4.6 billion from the peak in the first quarter of 2023. Now you can see there they paid $6 billion, but it only reduced the debt balance by $4.6 billion, implying that they paid $1.4 billion in interest expense. You can see interest expense really starts to add up when you've got that high a level of debt. Now, for the fourth quarter specifically, the company generated $5.4 billion in revenue, which was record amounts, exceeding the amounts before the outbreak, before 2019, and above what the company was expecting. Booking volumes for the 2 weeks around Black Friday and Cyber Monday reached an all-time high for that period, and total customer deposits reached a fourth quarter record of $6.4 billion, surpassing previous fourth quarter records of $5.1 billion by 25%. So, like I mentioned earlier, that part is true. Carnival is benefiting from that pent-up demand from consumers to get out and travel, and it doesn't hurt that Carnival has increased prices as well, so customers are now paying higher prices and they're booking more often, and that's been a formula that's been adding to Carnival's profitability and cash flow from operations throughout 2023. For the rest of 2024, for the full year 2024, management expects adjusted EBITDA, which is a proxy for cash flow, of approximately 5.6 billion, which is going to be up over 30% compared to 2023. That's more cash flow for the company that it can use to pay down debt. Net yields are going to be up 8.5% compared to 2023, with full year occupancy returning to historical levels and nicely higher net per diems, consumer spending, reflecting continued strength in pricing and onboard spending. Everything is more expensive. Ticket prices and all of the items you spend money on while you're on board the cruise ship. So it's higher prices, it's more people booking, and that's all benefiting Carnival right now. So let me share with you the opportunity. So during 2023, they made $6 billion in debt payments, which brought down their debt balance, and that's more than the $5 billion they highlighted they were going to do. So looking forward, they'll continue to evaluate refinancing opportunities and opportunistically prepay additional debt. So they're going to keep looking at this. They expect durable revenue growth to drive increases in adjusted free cash flow in 2024 and beyond, which will be the primary driver for paying down debt, right? We're going to use this cash flow. We're going to use these boom times to pay down that debt. And let's see how much that could benefit Carnival Corporation to pay down this debt. So here I have pulled up Carnival's income statement for the latest quarter and the latest 12 months. And you can see here their interest expense is highlighted here in the yellow. So here's the 12 months ended November 30th and the 3 months ended November 30th with the more recent period on the left-hand side. So you could see for interest expense, $2 billion they paid in interest expense in their most recently completed year. $2 billion in interest expense. Now, the company generated operating income of less than that much, right? They only generated operating income of 1.956 billion. So they had to pay more interest than they generated in operating income, signaling that they could improve their profitability significantly by paying down that debt. The more of this high interest debt they pay down, the lower this interest expense will go, which will leave more profit on the bottom line, which will leave more cash to pay down more debt, and on. That positive virtuous cycle can go on for a very long time here because they've got a very elevated level of long-term debt, as we noticed here, 30 billion. And so they can continue doing this until they get this back down to about 10 billion, because this debt that they accumulated before 2020, that's moderately low interest rate debt. So this isn't debt that would be very opportunistic for Carnival to pay down. They wouldn't want to pay that down because that's at a good interest rate. That's favorable debt. It's this debt that they accumulated in 2020. That's the trouble. That's the opportunity. This 10 to 30 billion, so 20 billion roughly left to pay down. And that debt, with each billion that they pay down, is going to bring down their interest expense meaningfully as they move forward. So that's a huge opportunity to pay down debt, reduce interest expense, increase profitability, which will increase the amount of debt they can pay down, which will then increase profitability, which will then leave more profit to pay down debt, and on until they get this down to close to 10 billion, which is going to take them several years to be sure. So this is one thing that smart investors are paying close attention to, with Carnival stock as a huge opportunity to boost profitability. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.